I just want to welcome everybody to the Owner's Edge Summit. Today is going to be the first one that we're doing, and it is on smart strategies for business owners. Who doesn't want to hear about tax and strategy? So we're going to be talking about that. I just want to introduce myself. For those of you that do not know me, a lot of you probably do, but I'm Stacy Bartleson with the Bartleson Blesner Wealth Group. And I have Molly on here, who is also on our team. She's waving right now. Jen Roth also helps with the Owner's Edge Summit. I see she's on here. And so our goal, if you came to our summit that we had in May, is to help business owners just around different topics on growing, scaling, and selling, starting, growing, and selling a business. And as you see here, it's to grow smarter, prepare earlier, and exit stronger whenever that time may come. And so we built this for business owners to learn from other business owners, but also advisors like Kyla today that can give you guys information to help you guys build value in your company, make proactive decisions to scale your business and position your business and life for a stronger exit. We do have some upcoming events we want you all to know of. And so we want to put them at the beginning here because some people might have to drop off. So upcoming events, our next webinar. So our goal is between the summits, which the next one you'll see on here is October 8th from 12 to 6. Opening will be 12 to 1 with registration, and there will be some networking at the end from 5 to 6. So hopefully you can all make it, spread the word. We'd love to have you come, and it's titled Building Resilience in Business and in Life. And so we have some great business owners on the panels, and we'd love to have you join us for that. But then between them is these webinars that we're doing to bring even more information and knowledge to business owners. And the goal is that we keep growing this. People can jump on. The next one's going to be a lunch and learn, which is September 10th from 12 to 1. Put that on your calendar. And that is marketing your company for business value and your customers. So we'd love to have you join that. Our very own Jen Roth will be sharing that topic with us. So I just want to thank you all, because taking time away from your business to just learn about, especially taxes, Kyla makes it fun. She's going to share some great information, but we just want to say congrats and thank you, because it does take time away from your business to come learn. So I want to introduce Kyla is a CPA with JAK, which is John A. Knutson. She joined them in 2005. She leads the assurance department, and she also is a certified valuation analyst. We work very closely with Kyla and our business owners to come up with the best strategies for their business based on where they're at and where they want to go. And she does all sorts of things for business owners. A lot of times that runs into the individual side. John A. Knutson has been around for over 100 years, like we have at Edward Jones, and they have all different services for individuals, business owners. We've worked with them on gift and trust estates. And so I just want to welcome Kyla, because they're a great partner that we've worked with to help us in many different situations. So I'll let you take it over from here.
Great. Thank you, Stacy. So I'm going to try and just sprinkle in a few things. Start by talking about some value items, some structure as you're thinking about an exit, whether it's soon or way down the line. And then a few pieces of tax, because I'm also a CPA, CVA. I got to always throw in a little tax information as well. So, I like to start with, when you're thinking about succession planning, there are things you can do now, no matter how far down the road your exit is. Number one, have your financials on accrual basis. A lot of business owners are on a cash basis, meaning for tax purposes, you pay tax on when your customer pays you, and when you pay the bills, you get an expense for that in that time period. Accrual basis is track your receivables, your payables. That is really the foundation of how you get to value, because it doesn't make sense if you think about it. Like, why are you calculating your income stream based upon when your customer decides to pay you? You can do some things to add credibility to your numbers. It's called GAAP financials. There are several levels, which I'll get into, audit, review, compilation. That just gives more credibility to your numbers. Another thing you can do is start reconciling your balance sheet, clean up your depreciation schedule. avoid personal expenses in the company, because if you think about it, if you, let's say you expense that $1,000 trip and you're visiting a customer, I don't know, a lot of times value is based on a multiple of your income stream. So think of that $1,000 times a multiple of 3, you just lost $3,000 potentially in your value, which if you think about the tax side, that $1,000 is maybe worth a 30% deduction. So, everybody wants to reduce their tax bill, but think about how that may impact you in the future. Another thing that you can do, aside from the financial and tax bucket, is think about your value. Know what's called your EBITDA. That's really your net income plus depreciation, amortization, interest, and taxes. A lot of times your value is based on EBITDA because you're selling your income stream. And if you add back the non-cash items, the bank financing and taxes, you get to what the core operations is really kicking off for a cash flow perspective. Along with that, look for weird things. And I'll go into this a little bit more later on, but if you moved, make note of that. You could even do what's called a normalized EBITDA. So you've got your cash flow from the company, but it's like, oh, I moved, that cost 50 grand, add that back because really we're, again, trying to sell an income stream. Know your risk profile. I'm a valuation professional that can help you calculate value. I'll get into that a little bit more. The third bucket is think about your workforce. Do you have key employees? Can you get some sort of employee retention agreement together, do some sort of deferred comp? Because when you sell the company, hopefully there's still management there. You'll get more value for it if you've got a good workforce that the buyer can just step into your shoes and continue on. And for key business owners, go on vacation. It makes yourself less valuable to the company. If you're the key person and you're selling and you're there 10 hours a day, 12 hours a day, that will hurt your value long term. So go on vacation. That empowers your staff to make decisions. It helps identify holes you have where you can like maybe a dual signer issue or something like that, so that you truly can step away in the end and still have a lot of value for the company. And also look for, maybe internal successors. Who do you want to sell to? Do you want to become employee owned? Do you want to go to a third party broker? All those things. So just a good snapshot of things to think about while you're owning a business. So a lot of people, I just wanted to touch on this, and I lead the audit and a test division, so it's kind of my passion is GAAP financials. And a lot of people don't realize there are actually 3 levels. If you are not getting issued financials, a good place to start that's cost effective is getting a compilation. It's cost effective. It's putting the CPA's names on your books. They look at it. We'd say, yep, you're in compliance with GAAP. It's a good starting point. Then you could upgrade to a review, which is probably about 30% more in cost than a compilation. And we dig deeper. We look at analytics. We do more inquiry. It's very common for lenders and maybe surety agents to require a review. 3 times the cost of that is an audit. And that is basically, we cannot trust you. We have to dig into your internal controls. We have to do third-party verification. It's the highest standard, which is why it's very expensive. There's certainly a place for it. Depends on the risk too. For example, if you have a $20 million line of credit, they're probably going to want an audit. But I hear a lot of people say, oh, we need an audit. And it's like, really? Let's just make sure. Let's pause and make sure. Sometimes we can even talk lenders down to a good solid review, which can save a lot of money. But really, the nice thing about these is down the road, it gives credibility to your numbers so that when you're selling, people will put more assurance on that, and that should increase your value because it reduces their risk from buying you that they know that you're on generally accepted accounting principles. Yep. So I mentioned I am a valuation analyst. I am certified to do full-blown valuations. I choose not to. For me, it's really a capacity issue and a fit for what my clients need. And I'll just talk briefly about these different foundations. There's something I will do is a rule of thumb range of value, which a lot of brokers and other people will do this as well, where you take the income stream. Remember, I mentioned that EBITDA, your net income plus the non-cash plus the bank interest and taxes, and look up for your industry, like what is a multiple of that, a multiple of revenue, and come up with a range of values. I typically look backwards 5 years and just say, well, on average, your company is probably worth between here and here. I'm governed by the AICPA, so I cannot actually state a value in this engagement. But like a broker, maybe your wealth management could as well. It's a nice place to start if it's like, do I have an estate problem? I'm thinking about selling, but I want to just, without spending too much money, just want to get a feel for where I'm at. However, that's not a valuation. It doesn't bring in the valuation concepts. A service that I do provide is a calculation engagement. That's a written report. It's about 8 pages, and it brings in the true valuation foundations of building a cap rate and applying it to your income stream. And we can do that 2 different ways. We can look backwards, and we typically look backwards like 5 years, and normalize it, meaning you look for those moving expenses. You had a bad debt, PPP income, whatever it might be. You normalize it and say, okay, well, here's the income stream that I'm selling. Then we go and we build a cap rate. We use Kroll, which brings in, the analysts out there that do a lot of studies. They come up with an industry risk premium. What is the risk-free rate of return right now, like a T-bill rate, size risk premium, and you come up and you build this cap rate based on risk. You apply it to the income stream and you come up with a value. That's looking backwards. I typically like to look both backwards and forwards because, again, we're trying to figure out what is the income stream that you're selling. So the flip side of that is something called discounted cash flow. And that is where you value on projections. And you use the same cap rate in a slightly different way to come up with the value of your future earnings. I like to blend the two and just kind of get a feel for where it's at. Now, a full-blown valuation would consider these 2 income approaches as well. It's much more detailed. It goes into industry benchmarks. What is your current ratio, your inventory turnover, compares you to your peers, looks for market comps. So think if you're like selling a building, you look to other buildings being sold. Same idea for valuing a company that's being sold. I find for my client base that third market approach doesn't always fit well because typically in that database, it's really large companies. But so just to kind of give you a framework for the additional things we're going to talk about, these are kind of how the value pieces come together and how you can look at it. Now, when you are building a value from the income stream, you do look for, that's called the enterprise value. Then you look for, does the company have anything extra, or is it lacking anything? It's called non-operating assets and liabilities, and that would be an addition or subtraction to your company value. For example, you have a piece of land that really isn't tied to your operations. We would add that land value back in. On the flip side, maybe you have negative working capital. You don't have enough working capital to support your income stream. So we're going to subtract that. Or you have you bought out a retiring partner and there's a loan you owe him. That would be a subtraction to come up to the value. So there's really a lot that comes into play when you think about value. Something else I like to say, and really, I started with this slide back when there was PPP funds in everybody's bank account, but $1 in cash equals $1 in value. If you take that dollar and reinvest it in yourself, it's a multiple. So like I said, if you spent that $1,000 on the trip times a multiple of 3, you just cost yourself $3,000. So on the flip side, what can you do to reinvest in yourself to increase your profitability? Maybe you invest in AI. Maybe the new website, which helps with finding new customers. You buy that new piece of equipment. Maybe you were, needing to do a bunch of repairs on your old piece, or maybe there's just something that makes you more efficient. Training your staff, things like that. Just when you spend that dollar, realize, yes, it's $1 less in the bank account, but hopefully it'll give you a multiple of that. Getting back onto the discounted cash flow, as it's called, valuing on projections. I think it's a great idea to just start doing a 5-year projection. It's a crystal ball. It really is. But if you can start doing that and then each year compare to how did I actually do, that can give a really good history for you to show somebody down the road and give credibility to valuing on projections, assuming that those projections are good and you want the value to go that way. Also, a lot of times, especially if you're looking for ESOP or private equity, they really do focus on the discounted cash flow, valuing on projections versus history. So again, if you show like, I've been doing projections, I'm really good at it. Here's my projections for the next 5 years. You just reduce the risk that a buyer would be taking on you, which should in turn increase the value of your company. And, even if you just do revenue, gross profit, net income, it's a great starting point. I've had a decent amount of clients concerned about their value, considering how weird 2026 has been. So something you can do to help protect your value or mitigate concerns is pause and think, what was weird this year, and document it. Maybe you were down by ICE protests and people weren't coming into your shop to buy your cookies or whatever it was. Maybe you own a restaurant and half of your employees were scared to come. So then now all of a sudden you're paying overtime to your staff. If you can, number one, make a memo of what happened, and if you can even quantify it, like overtime, that really will help soften the impact of this weird year on your financials. Also, another thing that I had clients, aside from people being scared to come to work, job sites where they couldn't get to the job site. Things were delayed because the pile drivers didn't go because they had issues, and then now you're backed up and contracts are delaying. So just anything that you can quantify, super helpful. Another issue, tariffs. Do you have extra costs because of tariffs, surcharges, extra labor, customer slowdown of purchases? Like anything you can document will really help in the long term, just to help soften it. And you can even, if you're getting issued financial statements like a compilation or a review or whatever, even if you just are using QuickBooks, just try and segregate everything you can into separate accounts for these issues. So when you look backwards, it's easier to identify. If you're getting issued financials, you can ask your accountant to carve these out in a separate category in a back schedule. Certainly can do that. So something else, aside from value, something else I want to touch on is, because it's not, if you sell your company for $1 million, the after-tax proceeds can be very different based on your tax situation. For example, if you're selling a partnership, it's a chunk of it is going to be ordinary income, meaning taxed at the higher normal individual tax rates. If you're the buyer and you have a partnership, you get a step up. I'm going to try not to get too tax geeky here, but you can get a step up for what you're acquiring and start writing it off. So that's a difference if you're a partnership. If you're an S Corp, it could be capital gain rates. It could be ordinary income rates if it's a stock sale or an asset sale. C Corp, it can be, again, either a capital gain or ordinary income rates. You possibly could have double tax. And I'll get into another slide, this gain exclusion. So something to note for C Corps is, let's say you sell the assets of your company. Well, you have some equipment. Okay, your equipment, let's say your equipment's worth $1 million, but you've already written it completely off. Now we have $1 million sale for selling your equipment. Well, that $1 million goes into your bank account. And because you're a C Corp, to get that money out, it's a taxable dividend. So that's what the C Corp double tax is all about. What you might be thinking, oh my gosh, why would anybody be a C Corp? There are other reasons. And I'll get into that. There's no right or wrong. It all depends upon your path and pros and cons of each type of entity. But just realize there are different tax considerations when you sell your company based upon what type of entity you are. And maybe there's some pre-planning you want to do here for whatever your end goal is. And I touched briefly on asset sale or stock sale. I'll go a little bit more into that. So if you are buying a company, you would want an asset sale. And it's easiest for me to think about like a vehicle. If I buy and doing an asset sale, I get to write off that vehicle. I get to buy it and write it off. If I'm doing a stock sale, that vehicle has already been written off. I don't get to write it off again. It's not lost dollars. You wind up getting credit for it on the back end. It's a part of your basis, stock basis. But essentially in a stock sale, you just step into the shoes of whatever that seller had done. Another piece on the asset side, if you're selling a company, you wouldn't want to sell the assets because in general, because the things that were already written off, like that vehicle, whatever value goes to the vehicle is ordinary income to you, the normal tax percentage on there versus capital gain. Now, granted, if you're getting to intangible value, meaning you're buying the company for $3 million, hard assets are worth 1 million, you'd have 2 million of intangible. Intangible would be at a capital gain rate. So anyway, just lots of things to consider there. To make things even further complicated, you can have a stock sale and treat it like an asset sale. So it's really good to include your accountant in these conversations and your whole team, so that you're aware of the implications of the decisions that you're making. People just don't always necessarily realize all these nuances. So I'd mentioned on the C Corp side, there are some benefits of being a C Corp. One of those, the really big one, is something called 1202, Qualified Small Business Gain Exclusion. And what it is if you're in the correct industry, if your stock was issued in the correct period, and you sell the stock of your C Corp, you can qualify for 50 to 100% gain exclusion, meaning when you sell the company, if you fit into this bucket, you may pay no tax on the sale of your company. There are rules about how big the company is. Talk to your CPA. In July of last year, part of that Trump One Big Beautiful Bill Act improved the gain exclusion rules, where there is this tiered period of gain exclusion based upon how long you've held the stock. But the issue with 1202 is you have to look back to the tax law at the year that the stock was issued. You can also be like, hey, this sounds really great, but I'm a S Corp. Like, I want to take advantage of this. You can flip to be a C Corp. Again, you can change your entity status every 5 years. But the nuance there is if you flip to a C Corp and you're worth $1 million, you only get the gain exclusion on the spread. So if you were worth $1 million, you sell for 5, well, then you have 4 million gain exclusion. Again, there's so much to this. You cannot know everything as a business owner. Just get a trusted CPA and talk through these things. Another tax saving item is the building. So a lot of times a client or a business owner, they have their operating company separate from their building, which is typically in an LLC, which a lot of times is just owned by one owner, and the rent is reported directly on the individual tax return. So when I hear of a client selling, one of the first things I think about is, are you going to sell your building? Yes. Oh, okay. And it's being reported directly on your 1040. This is an opportunity to save you money. If you can pop this out onto an actual partnership tax return, a separate tax return, you would qualify for the pass-through entity tax, which in Minnesota is an extra 10% deduction. So this is a workaround to the first Trump tax reform of 2018, where the $10,000 cap was set on your real estate tax and your income tax. So the pass-through entity tax, which it's been around now for quite a few years, so a lot of you are probably familiar. If you're a S Corp or a partnership, you qualify for this part, potentially qualify for a pass-through entity tax. Of course, they have to be complicated, so you need to have the right types of owners to qualify. But if I take a step back, what does this mean? If you have your building owned by one person, give 1% to your spouse, give 1% to your kid. Do something so that there are now 2 owners, which means it's forced onto a partnership return, and then you qualify for this extra 10% deduction. So to put numbers to it, you sell your building for $1 million gain, you get an extra $100,000 deduction just because there are two owners. And the company would pay that Minnesota or whatever state you're in, about 45 of the states have one of these taxes. They would pay your Minnesota tax. And then on the back end, when you file your individual return, you get a credit for taxes that were paid on your behalf. So it's a great way to just build in extra tax savings. I thought I would, I've been talking about a lot of these things, but I thought I would just highlight the things your accountant can do to help you as you're considering selling. I've talked about the asset sale versus stock sale. Your CPA can help quantify the difference, because maybe, like I said, sellers want to do stock sale because they get capital gain treatment. Buyers typically want an asset deal, maybe risk of buying the stock and not sure what skeletons are in your closet, or they just want to rewrite off the equipment. So it's a negotiation process, and your CPA can help quantify your after-tax dollar difference in the two scenarios. I frequently am a part of the team to look at the purchase agreement while it's being drafted, and look at the schedules, accounting and tax perspective of things, and just help make sure that my client is informed as to what that translates to for them. As I mentioned, pre-planning for reorganization, if you want that gain exclusion, or you want to make that partnership onto its own tax return so you can have the pass-through entity tax. Also for spin-offs and things, you can get really fancy, and there's certain holding periods that may be required. You can only change certain types of entity status every 5 years. So there's just a lot, not to scare you, but there's just a lot that can go into this. And a lot of times I do put pen to paper and okay, after tax proceeds in this model versus that. Here's what you would walk away with. If you're selling each year, if it's under if you're spreading out the gain across years. So there's just so much that we can do to help you with it. Another key item, which I don't know if any M&A attorneys are on this call, but there's something about your S election. So if you are an S Corp, be careful not to blow your S election, which that's really what it's called. So when you're an S Corp, you can only have certain types of owners. You can only have a certain number of owners. You have to pay distributions pro rata, meaning if you are 50-50 owner, Paul takes 50 grand, Peter needs 50 grand. Or you can blow your S election, which means you have two classes of stock. Okay, what does that even mean? It means that if you blow your S election, you become a C Corp, and that distribution that you just took is now a taxable dividend. So I've even seen in transactions where there's been question of that, and they require an extra insurance policy if they're buying the stock, in case the IRS does come back and say, you blew your S election, you aren't an S Corp. We want all these you've got late filings now, you owe all this extra tax. Just pay attention and listen to your CPA. Talk before you bring in a new owner. For example, if you bring in a Canadian member, that's a problem. You're no longer an S Corp, and we have to figure out corrective action. So just always consult with your accountant. We love to know what's going on. And there's just so much to know. You cannot know it all as a business owner. just a couple slides left. I thought I would sprinkle in a little tax update on Minnesota. So back in July, July of last year, the One Big Beautiful Bill, there were some new provisions that came in or were renewed. And Minnesota is a quirky state, meaning just because the IRS or federal changed the tax rule, Minnesota needs to meet and decide whether or not they're going to conform with it, which was frustrating. It is frustrating. So what it wound up being this year is, come year end, we knew the rules for federal, the year end meaning 25, but we didn't know for Minnesota. And one of those things was the pass-through entity tax, which I talked about earlier, where the S corps and partnerships that are on a Form 1065 can pay your tax and get a deduction for it. We didn't know until May of 26 whether or not Minnesota would allow it for 2026. So we found out they are retroactively conforming with it. So as a business owner, your accounting firm may have said, they're in first quarter of the year, and now we're like into second quarter, or past that. They may not have had you pay your estimates at the entity level, your business level, for Minnesota pass-through entity tax because it didn't exist. For most of my clients, I said, I don't understand why Minnesota wouldn't extend it because they get your money and they get to get interest on your money. So I think they're going to conform. So a lot of my clients, this doesn't really impact them because I had them pay first quarter. Minnesota is allowing you to catch up through Q2. I realize we're past the June 15th date, but if you fit into this bucket, catch up your Minnesota payments now. They charge a late payment if you don't pay your tax timely, and it's like 6 to 11%. So just keep an eye on that. The other thing that was big with the One Big Beautiful Bill was if you had research and development credits in the past few years, like 3-4 years, the IRS was making you capitalize research and development and then amortize it over 5 years. So they were just slowing down your research and development deductions. Well, they got rid of that last July, and they said, okay, companies that had this, either you can do what's called a super deduction, write it all off in 2025, or you can go back and amend the prior 2 years and just undo that capitalizing and expensing. Okay, so we knew what to do there for companies at the end of 25. Well, Minnesota, we didn't know. And again, in June, we found out they did conform. So we don't have to, we expense it for federal and then had to go back and capitalize it for Minnesota and then amortize. No, Minnesota decided that they're just going to conform. You may need to, if you filed your return, you likely will need to amend your Minnesota return if you fit in this bucket. Minnesota is saying they will not auto adjust for this if you filed your return and followed the current tax law, which was that you couldn't expense it all for Minnesota. It's frustrating. I know. I guess the other piece, which I don't have a slide for, is similar to all these. We found out that bonus depreciation, meaning you can write off some things very quickly, is Minnesota has conformed with that as well. So those are like little tidbits that I think business owners find useful. I don't know. I think it's just important to highlight that it takes a team to help you through owning a business, selling a business. A lot of times, with collaboration, I help be on the calls with the attorneys to look through transaction documents, help with due diligence. A lot of times, the work I do with modeling after-tax cash flow for clients then goes to the wealth advisor, like Stacy, and they can take that and be like, oh, is this enough for you to retire? Here's what this looks like. Exit planners, there's just so much that can come into it. And I love to collaborate, and I love it when business owners let me do that for them. So I think we've kind of highlighted how I can help. Even if you're not a client, feel free to reach out to me. I'll help visit and talk about your situation and see where it goes.
Kyla, would you mind going back to the page with, just to reiterate the next dates coming up? We appreciate you guys all taking the time out of your day to join. And hopefully you got one or two things. I always say from every event, take one or two things from what you listen to and go implement them. But if you do have questions, please reach out to any of us on the team in regards to Owner's Edge, or even Kyla as well on tax. But as she said, we all collaborate very closely when it comes to helping businesses grow to sell, whether it's marketing, which is Jen's specialty. We help with financial coaching, valuations, making sure people have the right number to sell someday after tax, working with your tax person to live the life you want to live and leave a legacy for your family. So we just want to thank everybody. I just want to remind you, our next webinar, which these are at no cost to you, just giving you more information to help you scale your business to where you want it to be to exit stronger, is September 10th with our very own Jen Roth from Blue Spark Marketing from 12 to 1, marketing your company for business value and your customers. I'm so excited to hear about that as well. And then Owner's Edge Summit, follow us on LinkedIn, Owner's Edge. You'll kind of hear everything that's going on, our panelist speakers as we get moving on that. But put on your calendar, October 8th, Building Resilience in Business and in Life, and Dakota Country Club from 12 to 6. So put that on your calendars, share it with everybody else that's a business owner that you know. We really appreciate you all and hope to continue to grow this. So spread the word on our webinars, summit, and our LinkedIn. Thank you so much.